This is Rod Kusanen, Spooman for Risk, and in this video we're going to be talking about scalping through the use of range bars, order flow, and the premium. Now, in our world, a range bar is any bar that has moved at least 2 ticks without a subsequent retracement of at least 1 tick into that range bar. So we've set up our range bar definition using our range bar indicator, where the minimum tick move is at least 2 ticks, and we have 2 bars subsequent to that bar wherein there has been no retracement. Therefore, based on the interval, which in this case is 20 seconds, you now have time to take advantage of the scalp. So we've identified all of our range bars with a solid colored magenta bar. The order flow bricks are to the right of it, and our premium is down below. So here we have a 2-tick move and no subsequent retracement into that bar in the next 2 ticks, or pardon me, the next 2 bars. Now, as we moved up here to this high, we see the footprint is showing selling and more aggressive selling in the next bar. We have divergence on the premium both here as well as the next bar, giving us a good reasonable short with a fill of at least the low of this bar, meaning we've only got a two tick move down to take advantage of. Now that's not a lot, but the idea would be to set up the limit order at least 1 tick below the high here. Now, if you're familiar with reading the order flow, however, you have a strong basis for expecting more than that because of the quantity of sell orders that have preceded it. So this is more likely going to be a 3-tick scalp rather than just a 2-tick scalp, since the probability of getting filled at the high here is pretty small. So you've got 1, 2, maybe 3. But at least you know where to enter. And now you're writing this down, and the order flow is, of course, confirming that you're going to get filled with regard to your limit order to exit. So that's our first example. Let's take a look at another. Now here we have a 4-tick range bar. Buys all the way up to the top. So now what you're going to look for is at least 1, if not 2, bars back into the range bar. A 4-tick move is virtually guaranteed. A 1-tick move back, 2 ticks, and sometimes 3. So your probabilities, of course, decrease with the amount of retracement, but your order fill can help you to identify when to exit. Nevertheless, as we move up here, and we're looking at divergence on the premium, we're getting a higher, and now we've got lower highs here on the premium. So you're looking at an entry here with a good solid basis for expecting a retracement. And if you were so lucky to get in at the top here using a limit order, it might have given you a very strong basis for at least a 1, 2, 3, 4 tick, maybe 5-tick move into the range bar. And all you had to do is know where to enter. Now you had a little bit of an issue here with this new high on the premium, so you might want to be a little cautious about that. But the probability of a retracement at least one tick into a 4-tick range bar is very, very, very high. Okay, and there you have it. There's your 1-tick move, then 2, and ultimately it goes all the way down to this particular indicator down here. Let's look at another instance. Now, you don't get too many of these based upon the definition that we used. Okay, now here's our next example. Don't let the order flow here fool you. Now, this is only a two-tick range bar. I'm going to turn off order flow here. We're using insider bars for that, to show you that there is really no tick above this level. All right, it's just the way the order flow bricks are being illustrated for you. But there's your range bar. You have no retracement on the next 2 bars. So we'll put the order flow back. And so what you're looking for, this is a retracement up at least 1 tick. Okay? Because you have really a 3-tick high here and the low here. So now this thing moves down. We don't get any buying in here. You've got divergence. So you're looking at 1, 2, 3. Okay. 1, 2, 3. Really a 4-tick retracement here with a high probability. Divergence, the buying, and the selling takes place over here. You've got your retracement, and nicely done. Now here's your next range bar. You've had a 2-bar move to the right and a retracement that's going to come down rather quickly. So there's at least a 50% retracement there, and of course order flow will tell you whether or not you want to continue with that. But in any case, if we put the order flow bars back in, there's our top, there's the selling, there's the divergence. So you've got 1, 2 bars down at best, not much to work with on this, as there wasn't very much vertical move to take advantage of. Now here we have a 3-tick range bar with a 1-tick retracement. Okay, back up to 38.50. Market has continued to move down. There's your divergence on the premium. Here's your buying. 1, 2, 3, and out at 38.50. Okay, so at least a 3-tick retracement there. And really, if you were so inclined to hold, maybe even 4 ticks. Now, a little later on, you've got this 3-tick range bar with a low at 39.25, a retracement down to 39.50. That would be what you would predict. Okay. Now, again, don't be fooled by this. This is not an order flow brick applying to the next bar, because the next bar opens at the close of the previous bar and continues on up. So we're looking now for a divergence. We get that divergence here. We have selling. So we have a good opportunity to exit or to enter the short here. Now, as it turns out, we don't get much of a move down as of yet. Okay. And this market continues on up. Again, you can rationalize however you wanted to play this. But in any case, you get this nice move down here, but this becomes a 3-tick range bar to the upside. All right, in other words, we're going to get a retracement back up. And on our next bar, we get selling, selling all the way into our range bar as we expected here, allowing us for at least a 1, 2, 3, 4-tick move. Okay. Or, pardon me, at least a 3-tick. At least a 3-tick move, depending on where you get filled. This one you could probably have gotten filled at the top, given the number of bars that we tested that top at 40.50. But now you've got this move down. And what you now need to see is enough buying with some divergence on the premium to ride this thing back up to 40.25. And here's the gift that you were given. Okay, you get all this selling, you get all this selling, all this selling. Now you finally begin to see some divergence developing in here, and you could have taken a long trade anywhere in here and done quite nicely, because you're looking at 1, 2, 3, 4, 5, a 6-tick retracement, and you do get it. Not bad. Another example here. So we have a retracement with a divergence here on the premium. 1, 2, 3, 4, 5, 6-tick retracement. Here you've got, look at this, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 point retracement. You get it here. Another retracement here, which is supplemented by this one here. And then that retracement later on. So the system and idea using both order flow and the premium works extremely well. This is using a two-bar right strength on the range bar. Now, you don't get as many when you use that system, but you have longer to work with. But these are 1/22 bar. If we only use a 1-bar right strength, we get much more. So we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15. Scalping opportunities using this, and only one failure right there. So in any case, nice opportunity to take advantage of this particular type of scalping technique. I'm Rod Kusin in Spoos.